Welcome to the Deep Dive. You've curated a really fascinating stack of sources for us today, all converging on this exact moment, December 22, 2025.
It's a critical moment for sure.
It really is. And this isn't just a snapshot of prices. It feels more like a deep exploration of how macro finance, central bank policy, and, the really high beta assets are all interacting.
That's absolutely right. Tech, crypto, AI.
Exactly.
And when you look across all these inputs, the market is, well, it's effectively being pulled in two very powerful, very distinct directions.
Okay, so what are those two forces?
On one side, you've got the highly technical machinery of the U.S. central bank. They're making these subtle but critical adjustments.
To the financial plumbing, so to speak?
Precisely. And on the other side,
yeah,
you have sharp, event-specific news, policy decisions, corporate catalysts, that kind of thing. And they're creating this really localized, acute volatility.
Right, especially in those high-growth sectors. It paints a picture that demands, a specific mindset. Your sources are calling it a framework of caution and event verification.
That's the key phrase.
So before we even touch on NVIDIA or Bitcoin, we need to understand the primary signal driving this whole macro backdrop. What is it, and why is it getting so much attention right now?
That signal is the New York Fed's action on what they call reserve management purchases, or RMP.
RMP.
Okay, so our mission here is to really unpack this, this technical liquidity move, how it works, why it matters, and then show how its sort of steady, cautious hand is interacting with the near frantic volatility we're seeing elsewhere.
In assets that are super sensitive to policy shifts, like AI chip makers or leveraged crypto markets.
Exactly.
Okay, let's unpack that macro anchor first. When we talk about RMP, I think most listeners get the basic idea of the Fed buying assets. But why is this particular program, these reserve management purchases, the signal the market is glued to? It feels so technical.
It is entirely technical, but in this kind of cautious environment, those technical moves become huge signals for the market.
I see.
RMP is fundamentally different from, say, quantitative easing. QE.
Right, QE was about broad stimulus.
Exactly. RMP is about managing the plumbing of the financial system. The Fed just needs to make sure that commercial banks have enough reserves to manage their daily liquidity needs.
So it's more about making sure the engine doesn't seize up from poor oil distribution, not about flooring the gas pedal.
That's a perfect analogy. The New York Fed started this program to strategically buy short-term treasuries. The initial plan we're hearing about is for about $40 billion.
$40 billion, and that's all aimed at supplementing bank reserves.
That's it, supplementing reserves and stabilizing the short end of the market. So we're talking overnight funding, very short duration stuff. Because the Fed is being so gradual on rate cuts, the market is treating the RMP execution pace as, the real indicator of liquidity health.
That's a crucial distinction, and it explains why the short-term yields are so sensitive to it. Looking at the curve now, the sources show the 10-year is holding around 4.17%. Volatile, but sort of stuck between 4.0 and 4.20.
Right, range-bound.
But the 2-year yield, that's the one we're talking about. It's highly sensitive, sitting near, 3.49% to 3.50%.
The 2 years where you see the immediate effect. I mean, if the Fed is actively in there buying paper at that short duration, it's going to influence everything.
And the deeper context is that inflation is still sticky.
It's grinding down, but it's not reliably below that 2% target. And employment is still pretty solid. So that combination, that's the Fed's dilemma. They can't cut rates aggressively, but they also have to prevent a short-term funding crunch. RMP is their tool to walk that tightrope.
Okay, and just for context on scale, the sources remind us M2, the broad money supply, is at roughly $22.3 trillion.
A huge number.
It is. So that makes a $40 billion RMP program sound, frankly, tiny. Why does such a small targeted action have so much power over rates?
And that's the paradox you have to grasp. M2, that massive 22 trillion figure, that's the reservoir. It's the total liquidity in the system.
Okay.
But the 40 billion in RMP, that's the pressure valve. It controls the distribution in the short-term pipes. The market cares about where the functional liquidity is right now. RMP is a surgical adjustment to keep those short-term flows smooth.
Which explains why rate traders are watching every single detail. Okay, that makes sense. That concept-stable macro plumbing supporting cautious policy is the perfect foundation for our next segment on event-driven volatility.
Exactly. We see that reflected in the VIX, right? The fear index.
Right. It's hovering around, 16, 17?
Yeah, around there. And that's not a panic reading, but it signals continuous market sensitivity. Traders aren't hedging for a collapse, but they're very, very quick to react to single data points.
And there is no bigger policy news item right now than the whole situation with NVIDIA. This isn't about earnings. This is pure policy. What's a specific issue driving all this volatility?
It all comes down to the potential for the NVIDIA H200 chip exports to China. The sources are saying the U.S. government is actively reviewing the conditions for those exports.
And the volatility is coming from the lack of detail on what those conditions might be.
Precisely. We're talking about billions of dollars in potential revenue, just riding on regulatory wording.
What kind of conditions are we talking about here? Can you elaborate?
Well, the market is worried about things like, will the U.S. require strict end-use verification, which could be a logistical nightmare? Or will they impose specific performance thresholds, maybe forcing NVIDIA to downgrade the H200?
Or even limit the total volume allowed.
Right. So if the outcome is permissive and leads to big orders, that's a major catalyst for NVIDIA. If the conditions make the exports non-viable, it's an immediate major risk.
It really puts the entire AI ecosystem on a knife edge. And we should probably note the other big tech drivers too. Meta is all about AI ad monetization, GOGL is tied to its AI applications, and TSLA is holding near that $470 to $480 mark, while traders weigh sales against costs.
It's a market that is just waiting for verification on everything.
And that waiting, that verifying attitude, it must hit the crypto market even harder.
Oh, much harder. If we pivot there, the caution we saw in the VIX translates into outright fear. The crypto fear and greed index is consistently low near 20.
20. So that's firmly in fear, extreme fear territory.
Deep in it, yes.
And that combination, extreme fear paired with high leverage, that sounds incredibly brittle.
Inherently fragile. An index reading near 20 means investors are deeply hesitant. So any minor negative news or even just routine profit-taking, it gets magnified immediately.
And you get those cascading liquidations.
That's what spikes the volatility in minutes. You see it in the price action. Bitcoin is near $88 of 4K, but it's just bouncing between, say, 85K and 90K. Ethereum is near $3 of 3Ks. Everyone's just watching on-chain data, looking for a sign of a break.
But amidst all that short-term fear, there are some long-term structural positives happening, right?
Absolutely. And it's vital to track those. Our sources highlight a lot of movement on the compliance and institutional front. Circle, for example, has been very active. They got the Abu Dhabi ADGM license,
Which is a big deal for USDC's international outlook.
It's huge. It solidifies its position in the Middle East as a regulated stablecoin.
Yeah.
And then you have Coinbase making a major commitment.
Right, in India.
Yes. Coinbase is resuming registration in India. They have plans for a fiat channel in 2026. It's not a short-term trade, but it's a very positive long-term strategic move. It shows the major players are still betting on regulated global expansion.
Okay, so we've covered the macro tension with RMP and the event-driven risk. Let's synthesize this into some actionable strategy for the listener. Moving to segment 3, synthesis and strategy takeaways.
The market's attitude is clear. Positioning is cautious, the market is event-driven. This forces a risk management playbook, and the sources offer 4 distinct recommendations.
Let's start with defense. With the Fed managing liquidity through RMP, what's the first priority?
Priority 1 is defense, liquidity prioritization. Given that RMP is manipulating the short end of the curve, retaining cash is key. The advice is also to deploy small allocations into short-term debt, money markets, or even gold as a hedge.
Gold is specifically mentioned, sitting near $4,370 an ounce.
Yes, it's acting as that traditional flight-to-safety asset. Its appeal is enhanced because it hedges against generalized volatility and offers an alternative against these rate fluctuations driven by the Fed's RMP moves.
So head to the short-end risk. What about the broad market? For someone holding index funds like VOO or QQQM,
Strategy 2 is phased accumulation. The recommendation is to use a disciplined dollar-cost averaging approach. Buy the dips.
but with a major caveat, I assume.
A critical one. Do not deploy all your capital. Retain substantial cash reserves for potential drawdowns. I mean, this is just not the time for an aggressive lump sum investment.
Which brings us to strategy 3, addressing that binary risk with NVIDIA and the H200 chips.
Right. This is the most acute risk management requirement. You have to treat the H200 news as something that needs explicit verification.
So you don't trade the rumor.
You absolutely do not. The strategy is to only scale up positions if substantive orders are announced and you get regulatory clarity. And just as important, you need a strict, tight stop-loss order in place if the regulation goes the other way.
Verify before you act. Got it. And finally, strategy for the most volatile piece of the market, crypto.
Well, given we're in extreme fear territory with high leverage, the primary advice is to maintain only small, Non-leveraged exposure to the core assets,
To Bitcoin and Ethereum.
BTC and ETH. The clear advice is to avoid speculative assets entirely.
Can you define what the sources mean by that? They use terms like HYPE and pre-stocks.
Sure, HYB just refers to those hyper-speculative, low-cap tokens driven by social media trends with little real utility. Pre-stocks are tokens that claim to represent pre-IPO equity. Both carry immense risk.
Legal and operational.
Absolutely. Unless you are a dedicated speculator using minimal, strictly controlled capital and you have personally verified the contracts, you just avoid these areas.
So that gives us a very clear framework. Defense first, DCA the broad market, verify NVIDIA news, and keep crypto exposure small and non-leveraged.
That's the playbook.
This has been a really comprehensive deep dive. The story really centers on the NY Fed managing the short-term reserve structure with RMP. It's a technical act that's become a huge macro signal.
And at the same time, you have these major policy decisions like with the NVIDIA H200 and this leverage sentiment in crypto that are just amplifying all the daily volatility.
It's driving this entire framework of caution.
Perfectly summed up. But to leave you with a final thought, consider the ongoing discussion happening right now in academic and institutional circles about the true nature of RMP.
Okay.
We established it's a technical move to manage short-end readiness. But the key debate is this. Does RMP inherently carry the implicit effect of balance sheet expansion?
An implicit expansion, you mean? Even if it's small and targeted?
Exactly. Even though it's temporary, any asset purchase increases the assets on the Fed's books. So this ongoing debate, is it purely a technical maneuver, or does it have a kind of stealth QE effect that's going to heavily influence how institutions position themselves over the long term?
That's a fascinating distinction, and definitely something to keep monitoring into the new year.
It is.
Excellent advice. Thank you for guiding us through this complex confluence of policy and price action today.